So I will start with accounting for assets and begin with accounting for PPE, property, plant and equipment. Then I will move to next I will go to IPSAS 16, investment property. So IPSAS 45. There's a time I was talking about IPSASes. When you talk about IPSAS, normally it is the purpose. What is the purpose of this IPSAS? Like every IPSAS comes with a purpose. For example, property, plant and equipment. The purpose is when you have those assets, those vehicles, those buildings, and the purpose is for administration. For IPSAS 16 or investment property, we say the purpose is for rental or capital appreciation. Then if you look at the inventories, if the aim or the purpose it is held for sale or for consumption, and that is why you apply. In fact, the same house, same building can have different purposes. One you apply under IPSAS 12 if it is for held for sale. Another one if it is held for administration, you bring in under this IPSAS 17/45. And the other one is if it is for rental purposes, then you take it to investment property. So PPE, we will look at recognition, measurement, depreciation, impairment, and recognition. So how do we recognize an asset? How do we first put them in our books? So assets, in the old days, we used to identify assets as fixed assets, especially those non-current assets. Nowadays, we categorize them into two. For assets, we categorize them into two, current and non-current. If you refer to IPSAS 1, the paragraph is 76. It tells you on how to categorize those assets. Current is if you will hold that asset for less than 1 year or 1 year. But if you will hold it or if you will have that asset for more than 1 year, then you categorize them as non-current assets. Okay, the other one is an asset can be tangible or intangible. It can either be tangible or intangible. Tangible is something you can touch, you can feel, like tangible. So example is motor vehicle, you can touch and it's held for use or rental or administration. Okay, so long lived, I said if you are holding it for more than one reporting period. Then in government, the main purpose is service delivery. We look at the service potential. That's why even in our books, you normally see in the statement of financial performance, we have surplus or deficit, surplus or deficit. But in the private sector, the aim is to gain. The aim is for profit making. So that's why you see in the private, in their statement of financial performance or income statement, it ends with either profit or loss. In government, since ours is to deliver services, you see surplus or deficit. For example, we may construct a bridge where in a remote area, but that is not possible in the private sector. So ours is service delivery. Let me check. Maybe you said something. Okay, thank you. So across governments, you see we have roads, we have hospitals, we have ambulances, we have servers, we have land, we have buildings. So the examples are many. So the key definitions. What is property, plant, and equipment? Tangible assets used over more than one period. The example I have given, motor vehicle. Motor vehicle is used for more than one year. Then when we are recognizing them, we look at cost. We look at cost. So we can either use the historical cost or revaluation model. So cost is the cash or the amount you pay to purchase or construct that asset. Depreciable amount. What is this depreciable amount? Depreciable amount is the amount, for example, an asset cost is 5 million, but the residual value is 500,000. So 5 million less 500,000, that is the amount you can depreciate. So that is the amount we call the depreciable amount. So it is the cost less residual value. Residual value is the scrap value. The scrap value. The amount it will fetch you now at the end of it is a useful life. Useful life is how many years can that asset serve you. An asset can serve you 5 years, 6 years. So those years which the management estimates in consultation with the professionals is what we call useful life. In Kenya, in the public sector, normally we normally provide guidelines like a car or a motor vehicle can have say 6 years. In the private sector, normally we look at from the perspective of taxes, and what we were taught in school in the old days was 4 years. So useful life for government is the number of years you will be able to use that vehicle. Okay, PPE is classified into several classes or categories. There's land, there's building, there's infrastructure. Among them, if you read this IPSAS 17 and 45, you will find that one asset mostly people don't think if it is part of this PPE is pear plants. The avocado tree, the mango tree, those are considered under property, plant and equipment. Animals, those used for surface, animals used for security, animals used in the zoo can also come under property, plant and equipment. So we have these classes. We have land, we have furniture and fittings, we have building. So these are the classes which we categorize these assets. It's found in both IPSAS 1 and in this IPSAS. So when can we say we can recognize an item as property, plant and equipment? Number one, do you control that asset? For example, what is control? Like you have a house, for example, or you rented a house. If you can deny someone from entering that house, or someone from accessing that item, or from using that surface, then you control that item because you can deny them. So the first thing is control, and you don't stop there. If there is no control, you do not recognize. But if there is control, you move to the next one. Are feature benefits probable? Feature benefit is, can you sell it at a feature date, or can you enjoy its service potential? Like, can it serve you? Can you use it to serve other people? If the answer is yes, then you go to the next. But if the answer is no, then you do not recognize that as an asset in your books. And then you ask yourself the third, can you reliably measure its cost? Like in accounting, if you cannot give a figure to those, if you cannot attach a figure to something, then you don't put it in your books. For example, you work in your entity. There is a place you work for. Can you say, or can you provide a figure you can attach to such item? If the answer is no, like you yourself, can you attach? Your CEO, does he have a figure? The answer is no. The only thing we can estimate is the salary you draw. That's the cost of the surface you offer. So that's why you don't see yourself in the books as an individual. So if you cannot measure something, then you don't recognize that as an item. So if you control, if you are deriving economic benefits like heritage assets, you don't recognize in your books, you do, you disclose. But if it meets all these three, then you recognize in your books. So for example, a county roads earns no revenue, but it provides a service to the public. So the county controls the road, and maybe if there is hospital there, the hospital, they carry service potential, even with no revenue, they give service to mwananchi, the Kenyans. So that itself, and then the fair value can be reliably measured. So you recognize the land, and the road as a separate item in your books. So initial measurement, what do we look at? What makes up the cost? At most or most of the times, we capitalize the cost of purchasing or constructing that asset. Then, if there is any discounts you are given, then you remove from the cost. The cost of site preparation, the delivery, the testing, the professional fees, the dismantling and restoration. So in most of the entities, they don't provide dismantling and restoration estimates in their books. So this one, for example, let me give an example like furniture and fittings. So in your office, you have partitioned. It is a rental office, you have partitioned. So since you have partitioned, and come 5 years or 6 years later, you may move out of that office, then you need to estimate the cost of dismantling, the cost of removing those furnitures, the cost of returning that, and then you add and capitalize and put it as part of your assets. For example, a generator machine or others. So this cost of dismantling and restoration is an estimate that is capitalized at the beginning of the. So this is what IPSAS 45 guides us to put as initial cost. But then imagine, even if the staff you train operates that item, IPSAS tells us don't put staff training as a cost to capitalize. Staff training, the administration and overheads, you don't capitalize. Initial operating losses, relocation and promotion. For example, a politician goes to a place to open that. All those are not part of capitalization of that asset. Okay, so this is the logic. All expenditures on the asset, if you know the cost to bring that asset to its working condition, to its present location and working condition, then IPSAS tells us we capitalize that asset. We put them in our books. This is an example. I gave it figures. So for example, a ministry buys a standby generator. So these are the costs. There is the purchase price. That one, the treatment I said include. Then if there is trade discount, you remove. If there is any trade discount, you remove. If there is any import duty, you include. If there is any import duty, you include. If there is delivery and handling of that asset, you include. If there is installation and testing, you include. But if there is staff training, you exclude. That is why here in my example, I provided a figure of 2,230,000. I provided a figure of 2,230,000. So what we capitalize is 2,230,000. What we capitalize is 2,230,000. The staff training, this is what you will do. Debit property, plant and equipment. Debit training expenses. Credit. I don't know why I've lost connection. Let me recheck. I don't know why I have lost connection. Okay. I don't know why we have lost connection. Did you lose connection same time for this Zoom? Okay. So let us proceed. Maybe you can type there if you have lost connection. If you have lost connection, you can type there. Did you lose connection like I did? Or it was a challenge on my side? Okay. So sorry for that. Sorry for that. So, so you debit property, plant and equipment with 2.23. Debit training expenses, then credit. That's how your books will balance. That's how your books will balance. What if what if you receive an asset at no or nominal cost? Like someone has donated that asset to you. How do you treat it in your books? A donor hands over ambulance to a county at no charge. So it is an exchange acquisition. There is no purchase price paid. So how do you treat it? If the donor gave you the price of purchasing that asset, then you credit revenue debit the price they have given you. But if they have not given you and you cannot find anywhere else, then what IPSAS guides you is that you go back to the market, do a fair value measurement of that asset, look at an asset of equal value at the same condition, then that is the price. We call it the deemed cost. And that is the price or the amount you will put in your books. And in this case, I said the deemed cost, the substitute cost, or the surrogate cost is 8 million. So you debit property, plant, and equipment with 8 million, credit revenue of 8 million. Revenue of 8 million. Okay. Cost after the asset is ready. A water plant is ready on 1st March. Spending after that is no longer a cost. So if the asset is ready, if the asset can be used, so capitalization also stops once that asset can operate as intended. So some other things like initial losses, relocation, like for example, your main office is Mombasa. If you want to take that asset to another area, for example, say Kisumu, you want to take it to Kisumu. So you don't add the transportation cost of transporting that asset to Kisumu. So you stop capitalization. So capitalization stops once the asset is ready to can be operated as intended. Okay. Cost after acquisition, what happens? After acquisition, there may be repairs. Repairs is the day-to-day servicing. So those is expense as incurred. So those small repairs, not major ones, those are expense. The major ones I'm talking about is something that can add value to that asset, something that can add value to that asset. So those you can add them in your asset. But if it's not adding value, then it is expense. Replacing. A major part is capitalized. For example, you had a motor vehicle, the engine knocked, and then you bought a new engine. So you recognize the previous engine and recognize the new engine. Then there is inspection. A major inspection is capitalized. For example, if you look at KQ, they normally do an inspection. Those aircrafts, they normally undergo inspection. So such inspections, we normally capitalize them. And then those regular inspections happen after 2-3 years. So if there is an inspection that was done, say in 3 years ago, and you have not fully depreciated, then you recognize the whole inspection, the cost and the accumulated depreciation, and recognize the new inspection. Okay, so this is an example with figures. Routine servicing is expensed. Replacement capitalized, they recognize the old part. I will share so that you can see what to debit, what to credit, but this one is straightforward. Major inspection of an aircraft. How do you recognize a major inspection of an aircraft? So the 3-yearly inspection is a condition of flying. So the 9 million inspection is capitalized as a component. Even though it's a surface, you may feel like this is a surface. How am I capitalizing this? Even though it's a surface, then IPSAS tells us something major and adding a value to that asset, then you capitalize. And when removing your books, you first recognize the earlier inspection and recognize the new inspection. Before I move to depreciation, any question up to there? Any question? Any question up to there? Any question? Okay, thank you. Let us move to depreciation. So depreciation, normally, if you buy, for example, an item, we expense immediately. But for major assets like vehicles, we depreciate them depending on the useful life. How many years can you use that asset? So because of wear and tear, so we depreciate those assets. And what we depreciate is the depreciable amount. If in the entity or in the area you work, the assumption is zero, the residual value is zero, then you depreciate the whole asset. And then some of the people, they do a mistake. What is the mistake they do? They wait until that assets figures goes to zero. IPSAS tells us we look at our assets at the end of each reporting period and see if the rate, if the depreciation rate or the useful life has changed. Depreciation spreads this amount systematically over the useful life. We can use the reducing balance. As you reduce, you multiply with a certain figure. As you reduce, so the NBV is what is multiplied, or you take the whole figure and divide by the useful life, and that one is called straight line method. So we can have straight line method and reducing balance method. The other one is unit of I think production. So as it produces units, then you depreciate. So you say the percentage of depreciation is equal to, if it has if you have used 20,000 and normally it produces 40,000, that it has depreciated 50%. So you can use either of those three methods depending on the type of asset. So each significant part is depreciated separately. What do I mean? For the aircraft, the engine is depreciated separately, the body is depreciated separately. For land and building, the land is depreciated separately, the building is depreciated separately. So there is this example: ministry vehicle cost 3 million with 600,000 residual value. So you take the 600,000, you take the 3 million, you minus 600,000. The amount that remains is 2.4. So you take the 2.4 and divide by the 6 million. So each year, in the coming 6 years, you will be depreciating 400,000 of that asset. 400,000 of that asset. So you debit depreciation 400,000, credit accumulated depreciation 400,000. Debit 400,000 as an expense, credit accumulated depreciation 400,000. Component depreciation. In this component, for example, in the case of the bridge, the steel and concrete, you will have different years, like a building, 50 years. For the road surface, the top layer, you can estimate 15 years. So you depreciate for 15 years. Joints and pairing, you can depreciate 10 years. So imagine a road can have different components. The same way an aircraft had different components, also a road can have different components. So this is just how each one disappears from the books. Land and building both together. Sometimes we make a mistake. We make this mistake by assuming that the land and building, if you bought them for 50 million, you do the same and say both land and building, you combine them 50 million. No. IPSAS tells us, and IS tells us, that the land and building are separated because the land always appreciates. The building can depreciate. Even though some buildings in urban areas, they appreciate in terms of cost, But the most common in government is our buildings depreciate most of the times. Okay, measurement after recognition. Measurement after recognition. How do we measure these assets after recognition? We can either use two models, the cost model, and the only is this current value model we used to call it revaluation model. But we currently, because of what came out under IPSAS 46, we say current value model, IPSAS 46. So the cost model is you take the cost less depreciation. You take the cost less accumulated depreciation, less accumulated impairment. So, and then you get the NBV. Cost model is straightforward and it is the most recommended in the public sector. For the current value model or revaluation model, you look at the operating value or fair value. Less later depreciation, revalue with regularity. For example, a school built 20 years ago, let us say the whole school you built for 100,000. If the school was built for 100,000, can you still assume that the cost or the value of that current value of that school is still 100,000? The answer is no, because our money at back then and today it has different values. Then you do this. Since you built with a value of 100,000, you first ask yourself, a similar school in a similar state at the current period, how much can you build? So you look for the fair value. Once you get the fair value or the cost of building that school, if you have the cost of building that school currently, you take it. For example, let us say in 50 million. If it is 50 million, you say how long was this asset serving you and how long did you estimate that this asset will serve you. You estimated this asset will serve you for 50 years and it has already served you for 20 years. Its remaining value is 30. You say 30 divided by 50 times the current value, which is 50. So the current value is 50, but you already covered, you have already used 20 years. So you remove that depreciation. So depreciated value, which is the current value. Alternatively, a professional can estimate directly without you using and depreciation to go back to the previous period. So a professional can easily estimate and tell you this is the value, the current value of this asset in the market. Okay. Historical cost model. Historical cost model, we say let us assume cost is 5 million, the accumulated depreciation is 1.5, the accumulated impairment is 200. So 5 million minus 1.5 minus 200, that is 3.3. The carrying amount or the net book value is 3.3. The current amount or the NBV is 3.3. The current value model, an increase lifts the revaluation surplus, a decrease usually hits the surplus or deficit. So the initially your asset was you valued at 8 million. Now you revalued and got a 10 million. So what happens? You debit your PPE with the extra 2 million, credit revaluation surplus with the 2 million. Initially, your assets value was how much? 8 million. Was how much? 8 million. But if there is any decrease to revaluation surplus, if there is any decrease to this is another example. So the first one we have sorted. The second one, if there is decrease to revaluation, your asset decreased from 6 million to 5.2. The 800 decrease, you debit, you reduce your revaluation by that amount and credit your property, plant and equipment. So it is a reduction to both your surplus and also your assets. To both your surplus and also your assets. Okay. So impairment and compensation. How do we handle? Impairment is a loss of service potential. For example, there is a wall. You have a building imezungukwa na wall. You have that wall. And then God forbid floods comes, ifagie or takes, it demolishes that part of the wall. So what happens? There is impairment. If for another example is, if you have a car and the car gets an accident, maybe it loses some parts. That is also impairment because it is not a normal depreciation. Impairment is covered under IPSAS 21 and 26. 21 for non-cash assets, 26 for cash generating assets. So loss is equal to carrying amount less recoverable service amount. The loss goes to surplus or deficit. Okay. When we are recognizing an impairment, we debit the impairment loss and credit accumulated impairment. Credit accumulated impairment. Okay. So compensation for if you are compensated for that loss, you treat this differently. You don't increase the value of that asset. The value of that asset will remain as it was, but if you are compensated, what you will do is that you recognize the revenue, the credit revenue, and if you have received the cash, debit bank, credit revenue, debit bank, credit revenue, debit bank. If you have not received, then debit receivable, debit receivable. The recognition, how do we recognize or how do we remove an asset from our books? An asset leaves the books on 1. Disposal, like you sold that asset, you transferred, or you donated that asset. So you de-recognize that asset from your books. You de-recognize that asset from your books. You de-recognize that asset from your books. Okay. Another way you can de-recognize is when no future benefits or surface potential remains. When no future benefits or surface potential remains. If you can no longer sell that asset, or if you can no longer use that asset, then you remove from your books. You remove that asset from your books. If there is any gain or losses when you are disposing that asset, then you take it to either surplus or deficit. You take it either to surplus or deficit. If it is held for sale, then there is another IPSAS that you use to recognize that asset. The IPSAS is called non-current asset held for sale. IPSAS 44. IPSAS 44. Okay. So a vehicle is sold for more than its carrying amount. The carrying amount was 3 million. What was sold for is 3 million. The carrying amount is 2.2. So the gain is 800. So that gain, you first do this. Debit bank. How are we debiting bank? The gain from proceeds is 1 million. So you debit bank, debit accumulated depreciation, credit property, plant and equipment, credit the gain or loss. So each side, the debits should equal to the credits. The debits should equal to the credits. If you look at in this example, my debits is 3.2 and my credits is also 3.2. So always the right side or the debit should equal to the credit. Otherwise, unless you want to cook your books later, then your financials won't balance. Your financials won't balance. So write off when surface ends. Obsolete surface carry a value but give no further surface. No surface potential remain and they are scrapped, carrying amount written off. So if there is no surface potential, if you can sell in the market, then you will at least hold some figure in your books. You only look for impairment. And by the way, IPSAS tells us, even if an asset is idle, you don't stop depreciating that asset. Even if that asset is idle, you don't stop depreciating that asset. So on disclosures, normally, if you had an opportunity to look at our reporting templates, this is where we normally say those assets, on disclosures, those notes show the disclosures. But then Ipsas tells us what we will, this is how we will reconcile. First, this is PPE reconciliation. We start with the opening, we add the additions, we less depreciation, less disposal, less impairment, add revaluation, and you get a carrying amount. This is logical. You always start the opening balances, and this note is also available in our reporting templates. So what we disclose, users should see how the asset base is measured and how it moves. So we look at the measurement basis and depreciation method. We look at the measurement basis, we look at the useful life or depreciation rates used. So that is what we disclose. We also disclose the carrying amount and the accumulated depreciations. We also do a reconciliation of opening to closing balances, the one I have showed you previously, the previous slide, in the previous slide. Okay. So areas we can look at: heritage assets. Heritage assets, if you have gone to the National Museum, you may have found that they are assets that we control, that we derive economic benefits. But the issue with those assets is that we cannot recognize them in our books because there is no measurement. We didn't buy them. We didn't buy those assets. Also, we didn't buy those assets. Also, we cannot sell in the market. We don't have a value we can attach to. So IPSA says we disclose. Then the infrastructure assets like roads, we componentize. So we look at, for example, the service, the lower, like we categorize them into components, like the way we categorize the aircraft. Then set a realistic useful life for each component. Spare parts and standby. Spare parts, if it is used for only 1 year, like the engine, for example, used for many years, we capitalize. But if something is oil or something small items, then we just expense them. The National Cereal Produce Board, for example, have those national reserves. Those reserves, or KPLC, those Kenya Pipeline, those, they keep reserves. Those reserves are inventory in our books. So we don't capitalize, but we put or record those as inventories, even if we hold them for more than 1 year, because the aim is to finally consume. So capitalization threshold, an entity can come up with capitalization. Someone can say 10,000, another person can say 50,000. So that capitalization threshold, when you are set it consistently, and materiality policy should apply. Okay, where other standards take over. For borrowing cost, there is the direct method where we expense any interest related to when you incur interest, when you borrow to buy an asset and you incur interest. There's two options IPSAS 5 gives you. The direct method, which is straightforward, which is expense every interest, or the allowed alternative approach, which is capitalize any interest related to that asset. So IPSAS 5 applies. So you refer to that IPSAS. For surface concession arrangements, for example, the expressway, we say that initially you apply IPSAS 32. Then for any item related to PPE, you apply property, plant and equipment and IPSAS 45. Then there is these assets. Once an asset becomes held for sale then you apply IPSAS 44, non-current asset held for sale. For deferred payments, you split interest if time value is material. If an asset is for consumption, then you apply under IPSAS tariff inventories. Here are common mistakes or errors we normally make. Capitalizing staff training instead of expensing it. Capitalizing staff training. So staff training should never be capitalized. Not de-recognizing a part that has been replaced. So when you replace an engine, recognize. Someone was asking me, how do we recognize, for example, de-recognize from a motor vehicle? And the cost was 1. For example, the cost was 5 million. So how do you remove it? Let me tell you. Any part in that vehicle has a value. Even if when you contact the manufacturer, they can easily tell you each and every component of. So when you replace a component like the engine, you can refer back to the original supplier and ask him how much was the initial cost, and they recognize that asset from your books. So you recognize both the depreciation amount and the cost of that part you have removed from your books. Okay. You can have building, and then as the land prices rise, then you don't depreciate. You say this building is increasing value. Revaluing only selected assets. When you are revaluing a class of asset, for example, motor vehicle, class motor vehicle, you are supposed to revalue all of those assets in that class. All of those assets in that class. So this is the end of property, plant, and equipment. This is the end of property, plant, and equipment. So this was a summary. Any question on this? Any question? Any question? Any question? Any question on this? I'm on Zoom and also on TikTok. So if you are on TikTok, you can also ask any question. You can ask any question. Any question, concern. Uptown Vintage, how are you doing? So you can ask any question, type there. You can ask any question. Thank you. So allow me to switch my slides. I want to go to IPSAS 16, investment property. I want to go to IPSAS 16, investment property. So allow me 1 minute to load that slide. Allow me 1 minute. Okay. So this is IPSAS 16, investment property. This is IPSAS 16, investment property. When I was starting, I said property, plant, and equipment, the aim is administration. For IPSAS 16, the aim is to earn rentals or for capital appreciation. To earn rentals or for capital appreciation. So what this standard sets out to do. So the accounting standard, or this IPSAS 16, sets the accounting treatment for investment property and what disclosures users need. So does IPSAS 16 apply to each holding? For example, holding number 1, block leased to private firm commercially. Does IPSAS 16 apply? The answer is yes. Ministry headquarters in own use. Does IPSAS 16 apply? The answer is no. Why? Because the aim is for administration. So you apply IPSAS 45. Houses bought and sold routinely. Does IPSAS 16 apply? The answer is no. What do you apply? You apply IPSAS store leave inventory. Low cost housing, let below market. Let below market. That's IPSAS 16 apply. That's 16 apply. No, you apply another IPSAS. And this says IPSAS 45 because the aim is not to sell and also for rental or capital appreciation. Okay, this is most probably those assets used in entities for employees. Okay, what's investment property? Investment property is land or building or part of building. Part, please not part. Because a building can have 5 floors and one floor you use for it for what can I say? For rental. So such part can be considered as investment property. 2. To earn rentals, leased out commercially. 3. Or capital growth, held for rising value, but not for use, or for sale, not for services or for resale. So how do we classify? Investment property, owner occupied or inventory? Owner occupied or inventory? I think this one is more of a repetition, but let us go through. As hospital land, just a minute. I see hospital land held for value. That's investment property. Vacant building to lease out. That is investment property. Building under finance lease. You apply IPSAS 43 leases. Military housing occupied. You apply IPSAS 45. So held independently to earn a return. Yes. Land held for long-term capital growth. It is investment property. Building leased out commercially. It is investment property. Vacant building held to lease out. It is investment property. Property being built for investment use. That's also investment property. So these are some of the examples and how you handle them. So what will fall outside the scope? Property held for sale, that's inventory. Owner occupied property, that is under IPSAS 45. Property, plant and equipment. Property on finance lease, that is IPSAS 43. Property for social services, that is IPSAS 45. Okay. Investment property versus owner occupied. Investment property, you know, the aim is to earn cash. Leased out or held for value. So the IPSAS is IPSAS 16. Owner occupied is used for service or administration, cash tied to other assets. You either apply IPSAS 45 or IPSAS 43. The mixed use building. Can the parts be sold separately? If yes, split them. Flats let out. IPSAS 16. Investment property. Office for admin. Owner occupied property and you apply IPSAS 45. Inseparable. Only investment property only if admin part is small. If administration part is small. But if you can separate the floors, then one floor is investment property, the other floor is property, plant and equipment. Recognition and initial measurement. How do we recognize? We recognize like the way we are recognizing assets, the way we are recognizing property, plant and equipment. You look at control. You look at probable future surface potential or economic benefits. We look at if you can reliably measure fair value or the cost. Then you recognize the asset if it can qualify all those. A country agrees to buy a rental block. Country signs contract signed, control not yet passed. Test not met, do not recognize. On transfer, recognize the asset. So the fact that you agreed to buy a rental block and you have not given the consideration, just the agreement, then that is not your asset. Initial measurement, what enters into the opening balance. Just give me a minute. Hello? Hello? So, what enters the opening balance? Measured at cost. Initially, whether you use the cost or revaluation or fair value, the initial cost. What is fair value? Fair value is the cost you will buy an asset or sell, you will sell an asset or distinguish a liability between knowledgeable market participants, willing buyer, willing seller, me and you. So we are buying from one another. So that's fair value. Even the cost, the initial cost is fair value. So you add any directly attributable cost, any cost that you can relate with to bringing that asset to its present condition and location, you add to the asset. You exclude startup and wasted cost. Any startup, any wasted cost. Then for deferred payments, use the cash price. Use the cash price. What does it mean? For deferred payments, by the way, if you deferred for 3 years, then you look at the present value. The present value. Okay. Computing the cost, a corporation buys a rental block. So the rental block purchase is 80 million. Then the other cost, which is 3.2 million. So the total cost is 83. Legal fees and transfer taxes are part of the cost. Day-to-day running are expensed and not capitalized. Okay, so we debit investment property 83,200,000, credit bank or payable 83,200,000. So this IPSAS recommends we use the fair value. And the fair value, if you apply this fair value, you imagine you will revalue you will revalue your assets at the end or each and every reporting period. If you apply the cost, then the value is used in accounting afterwards. So whichever approach you take, but the recommended one for investment property, is fair value, the current operational value or the market value. Any change or losses arising from that, then you take it to other gain or losses. A donated building or office block, no cash is paid, so fair value at acquisition is the cost. So if the fair value is 50 million, then you debit 50 million and credit revenue, non-exchange transactions. Okay, measurement after recognition. If you are on historical costs, you just do as per the way we were talking about on PPE, property, plant, and equipment. So you take the cost less depreciation, accumulated depreciation, less impairment. But for the current value model, you look at the fair value. Each year, there's no depreciation. Each year you revalue, and this is the one that's recommended. Okay. So for example, current value was 80 million, and then you revalued and you got 92 million. So you debit the increase investment property by 12 million. You credit other gain or losses or surplus or deficit, the 12 million, and your books will balance. So if the change in use, for example, if the way you are using it was for another purpose, and any asset, for example, an asset might come in as an inventory, might go to PPE, might come to investment property. So transfer only when use changes, and that requires evidence, not just intention. owner occupation begins, then you remove out of investment property. Commercial liens begins, then it comes into investment property. Investment property. Okay. So a ministry occupies a rented block. Use changes. IB becomes owner occupied. Reclassify under IPSAS 45 at that date. You reclassify under IPSAS 45 at that date. Okay. Disposal. De-recognize on disposal or when no future benefits remain. The gain or loss, you take it to other surplus, other gain or losses. So proceeds minus carrying amount, you will either have the gain or loss. Disclosure, if you have used the current or the cost model, you disclose. If you use the fair value basis, then you look at the independent value, who is the independent value, and then rental income, you deduct or the direct expenses. You also disclose any direct expenses related to that rental income. And then if there's any restrictions, if you use data set for loan, for example, to borrow loan and any other commitments you talk about. So we are finalizing. These are the common mistakes. Treating owner occupied property as investment. Capitalizing day-to-day running costs. Skipping fair value disclosure under cost model. Reclassifying on intention alone. So these two IPSAS, IPSAS 16, IPSAS 17/45, and IPSAS 31 intangible assets have many things in common. So any question up to there? Any question up to there for today? Any question up to there for today? If you have any question, you can ask. Any question? If you have any question, you can ask. Any question? Any question for today? I want to stop here if there's none. So maybe, okay, same name. I will share the notes. Currently, let me share the notes. I will share the notes for these two. But I will share in the group because your colleagues and some of them are not around today, so I will share in the notes. Okay, I will share in the group. So thank you for your time. Enjoy your day. Thank you for your time. Enjoy your weekend. Asante.